Well, in our first roundtable, we talked a lot about the supply side. And before we move on from that, Bob, real quick, we're going to get this acreage report later this month. There's a lot of estimates out there. But as we saw that incentive to plant and the window opening up in some places in the Northern Plains, do you think we could see north of 1 million acres of prevent plant?
I think it'll be in that range, but it won't exceed that. I think that prices are high enough. The planters kept on going. But then I think you'll see a drain on the yield. And so I think USDA is going to have to come eventually off the 177 yield. And that's going to basically make these supply demand tables tighten. And that's why the weather is going to be so magnified and influenced that from the acreage report to mid-July, that is D-Day, and it could be very volatile. But that's what the bear wants to see. You just mentally got to get your head in the game and ready for it, because it's going to be. I've been around since 1978, and Mark has been a little before that. I remember I came out of grad school and coming out into the markets and county extension agent, and we were just going into what the Democrats have done in 5-6 years. We've done it in 1 year, and then Volcker came in, and then we got into the 80-85 time period. I just don't like what I see coming down the way, and I want to get farmers prepared for that type of situation.
Mark, we did see some cancellations on exports this week. Do you think we are seeing any hint of demand destruction? And if not, at what price point do you think that could start to happen?
100,000 cancellations doesn't mean anything in these markets, in my opinion. And, have we seen demand destruction? Look at how strong the basis is. We don't see it yet. We will get to a price where we're going to ration the available supply. And the weather's going to get people all crazy. And all I can say is, look, buy yourself a put. You rally the corn a buck, roll the put up, spend 20 cents and roll up another buck, spend 50 cents on a bean put. If we rally $3, roll that up for another 50 cents or 80 cents to lock in that $3. What else can you do out here? You don't want to sell grain that might not be there, particularly with these kind of a drought potential out here. So, I think the only way to really manage it is with these puts. They're not cheap, but look at the prices you've got out here. You got $17 to $18 beans. You've got $7.50 corn, roughly. Prices you just can't ignore.
Bob, real quick, if we do see prices continue to trend higher, what do you think leads this thing? Corn, soybeans, or wheat?
I think corn and wheat, but next year I think bean acres are going to go up, and that's going to keep corn even stronger to 23. So we really have to be in a put philosophy. I completely agree with Mark. This is not a market where you just want cash is going to be king until we build supplies. And this thing could take clear into next season before we really have the bear in control. So the bear has to really manage his risk right now.
All right, Mark, on the cattle side, we've seen some culling going on this week. The high heat having an impact on some feed yards out in western Kansas, just devastating. As we move forward, you have lingering, this talk about a recession. Do you think it is supply, or do you think it is demand that will be the driver of these cattle markets in the months ahead?
We've seen box beef pretty strong out here. The rumors are we're losing 100 to 500 head per feedlot out here. That's a lot of cattle. We've seen pretty good demand overall, but the stock market going from 36,000 down to 29 and change certainly doesn't help things. American consumer gets a little bit cautious when he sees his IRA taking a big hit out here. Are they going to buy cattle, or are they going to buy something cheaper like chicken? So, I'm a little bit skeptical in the cattle market. We went up, filled one of those gaps that were up there. We backed off. It doesn't look bad. Slaughter has been strong. So hopefully we'll continue. But if the corn market goes crazy, feeders are certainly going to take a hit out here.
Yeah, and we're hearing, some talk that if corn does go higher, then maybe some of those other cattle contracts could continue to go higher as well. The opposite of that, Bob, do you agree?
I think we got a July-August correction. If this heat comes, I think the pastures are going to get really tight, and I think the feedlots are having tremendous problems with heat. We're going to have, and the weights right now are trending lower over the last 2 years. Weights are going down, so we're reducing the supply. But we got this difference between supply, weights, and inventory. But long term, I think cattle market could be a real bull market. So if we do have a solid sell-off on short-term July, August corrections, I'd want to be a buyer of the fat cattle in the back end in the April time period. But how high you will go will really depend upon how deep the recession comes and how the consumer feels. So it's going to be a battle. It's not going to be just a straight shot up, but I think the trend will be cattle will be firming long term once we get over this July, August time period.
All right, Bob, Mark, thank you both for joining us this weekend. We really appreciate it. Let's take a quick break, and then we have Grit with Grace next.